I'm Matt Bichard with REIT.com, and this is Fundamentally Speaking with Calvin Schnure. Calvin, let's start by talking about the industrial sector. The broader picture that we're seeing in the macroeconomic numbers haven't been that strong. And even the most recent employment report, while a bit of an improvement, was still somewhat lackluster. What's this all mean for industrial?
You raise a good point about the macroeconomy, Matt. We have seen a lot of weakness there, both in the U.S. as well as Europe and China, and that's obviously affecting the overall macro view. But the two latest reports that we've had related to the industrial sector have actually been surprisingly positive. Not a big positive, but some uptick, contrast to the macroeconomic news that was relatively weak. The first is just looking at the ISM Manufacturing Survey. And you can see here, it has softened quite a bit through 2011, and this is the first reasonable increase that we've had so far this year. It rose to 51.5 in the September reading, and that's indicating some further expansion of industrial output. We also saw the recent news on auto sales, which rose to almost a 15 million unit annual rate, which is getting back closer to the trend. Here, the second chart, you can see the long-term trend here over the past 15 years. The 15 years prior to the crisis was actually a bit closer to 16 million. So we're seeing steady improvement. There have been, one step forward, two steps forward, one step back, but we're seeing a better data flow on the manufacturing sector lately.
Now, if we can just drill on the ISM manufacturing number, that still seems fairly weak, though, as you pointed out, that the number's hovering right there at the 50 point, which is right between contraction and expansion. Isn't it just as risky that we could slip backwards?
Well, it's not necessarily a risk this would go backwards. This is a positive report. It's not a strong report. This is not suggesting a lot of near-term improvement, but what it is showing is the potential for further gains down the road, particularly when you look at motor vehicles. So let's look at the motor vehicle chart again, and you can see that the trend pace of sales in the 15 years prior to the crisis was over 16 million units, and then it fell quite a bit, and now it's coming back. There's something very different about an auto sale than consumer spending on going out for a movie, going out for dinner, a vacation at the beach, something like that. If you haven't bought the movie ticket or gone out to dinner, at the end of the month, you don't have to go out to the movie and make up for it. Cars are different. When someone has a car that they bought 12 years ago and they didn't replace it, and they wait a year for replacing it, it gets older and older, there's a pent-up demand for buying the auto. So what we're seeing is auto sales have been running well below the replacement demand for the stock that's out there. So we're seeing the cars on the road are older. The average age of cars on the road is a year or more older than it had been prior to the financial crisis. And actually there are fewer cars on the road. Look at the next slide here. This is showing an estimate of the number of vehicles there were, and it rose steadily throughout the decade prior to the crisis. It actually fell a little bit in a couple of years immediately during and following the crisis, and really hasn't moved up. What this means is people may still be holding off on replacing their car, but they can only do that for so long, and there's a pent-up demand that is going to be a strong force for the industrial sector.
So how much is all this going to impact the commercial real estate market?
Well, it'll have a number of effects. The first one is fairly immediate and obvious and near term. The pent-up demand for autos, for motor vehicles, the whole supply chain, and other industrial products that have a similar durable cycle, that's going to support the sector through the rest of this year and into next year. There are more indirect effects as well. One of them is just the macro effect, macroeconomic impact of greater sales in that sector, and is going to have greater employment. There's going to be more hiring, and that's going to give the overall economy a little bit more momentum going forward. Overall, this is one factor that gives a long-term investor another reason to say why real estate is a reasonably good proposition for them.
And are there any other parallels between what we've talked about today and the commercial real estate market?
Well, there are actually very strong parallels. The exact same story of a car being a long-lived asset, a durable good, is something that applies to buildings. Obviously, you build an office building, it's going to be there for 30 years, maybe longer. And right now, we're not seeing much new construction in office. We're not seeing a whole lot of new demand in office either, because there's not a very strong job market, not much hiring, and it's similar in retail. Other sectors are a bit different. Apartments obviously have done fairly well, but even there, you're not seeing construction to keep up with demand. So this pattern of a very sharp cutback in production, and then as the economy begins to recover, the new supply tends to lag, is what sets up for a very strong market afterwards. So just as you're seeing motor vehicle sales continuing to rise even though the overall economy is weak, the commercial property sector is continuing to strengthen even though the economy is weak, because there's a growing demand for the buildings that these sectors represent.
Calvin, thank you so much for joining us.
Thanks, Matt.
Be sure to visit REIT.com next month for another episode of Fundamentally Speaking.